A very good evening and a warm welcome to Personal Finance. I'm Kukuletu Tele. Are you paying too much for your investment fees? And how would you know if you are? Certified financial planner Peter Hewett joins me now for more analysis on this. Such a pleasure to have you with us this evening, Pete.
Thank you.
Let's touch on the fee landscape in South Africa. Are we finding that South Africans actually pay too much for their consumption of financial products?
Look, Gugu, I think generically the industry has gone through significant pricing adjustment over the last number of years. So you have found that a number of your fees related to various types of investment products, and for that matter, generally financial products, have been reduced over the last number of years. The regulators have been relatively involved in ensuring that clients do receive value in terms of the fee that they're paying for their various types of financial planning services. I ever believe that there are still certain products available that consumers are still utilizing that are relatively expensive, and I think it's critical when an individual wants to review his financial plan and financial planning structure that he gets his advisor to give him a detailed breakdown of all of the products that he's utilizing and the related fees.
I wanted to get into those products that might be a little bit too expensive in a moment, but the first point of call is obviously a professional like yourself, a CFP, and I understand there's regulations which might also change the contributions or the fees that you might also receive as a professional.
Yeah, I think in terms of the retail distribution review, effectively what the regulator is trying to do is trying to very clearly outline the structure of the financial services industry. You have people out there, for example, that refer to themselves as financial planners. You have others, for example, that just do pure product fulfillment. So they will provide a product and sell that product to a client, but won't necessarily be involved in the allocation of that product and the structuring of that product and the long-term maintenance of that product. So the regulator is at this stage trying to clearly define the various roles fulfilled by various components of the industry to make sure that a client understands what they're receiving and what they're paying for when they receive that specific type of service.
So for someone watching tonight, what should they take into consideration? A CFP who will charge you per hour like a doctor would, or via consultation?
There are a number of fee models available in the market at the moment. My advice to clients generically is that you need to meet with your financial advisor, give them an understanding of what your needs are, and then negotiate a service level agreement. And with that service level agreement, you need to agree on the fee that you're likely to pay in future on the various types of products. In most instances, it does make sense to facilitate your fee payments via the various product providers. And the benefit of that is that it doesn't have a direct impact on your monthly cash flow out of your current account, if you'd like to call it that. It's effectively the withdrawal of a portion of your investment to pay your financial advisor for the services that he renders. But you must make sure, of course, that you're receiving service that's commensurate with the fee that you're paying.
Exactly, and that would tie in with performance fees.
Correct. Look, performance fees generically are in place in terms of your investment products. So what you'll find is that an asset manager, for example, may have a relatively low base fee on a product, but obviously if you are offering, for example, an actively managed equity fund, many managers complement their fee with a performance fee within the fund. And if you look at the amount of research, the staffing involved and so on to run an equity fund, an actively managed equity fund, that fee structure does make sense, and it does give the client the opportunity to pay a very low base fee if the manager is not delivering on his commitments, and to pay a higher fee which he then shares with the manager if his investment returns are in line with what the manager committed.
Which I take it in the industry is viewed as something being fair.
Yes, it is relatively fair. There historically have been performance fees that were a little outlandish, but I think those have been largely aligned throughout the industry. I think what many people focus on nowadays, though, as you say, is the investment component of the fee. But you must remember that you have the advisor fee, you have the investment fee itself for the underlying investment, you very often have a platform fee, and you also sometimes have an actual product fee. So it's quite important to understand the breakdown of those different fees. Your financial advisor, for example, needs to literally get into his car, come out to see you, complete a whole load of documentation, and then service you and your family on an ongoing basis. You need to make sure that the fee paid to that financial advisor accommodates those various costs and so on to make sure that you are going to end up with a good quality financial advisor and not somebody who really can't afford to service you properly.
Exactly.
On the flip side, if you look at product fees, there's an area where definitely there are opportunities to cut your costs. And it's important that you get an independent financial advisor so that he can go into the market and assess a number of different product houses to make sure that you are paying the most competitive fees on your products and or platforms.
That's what I want to get into, because so often we hear that the 0.4% is probably what the industry average for a variety of investments when you look at ETFs or even unit trusts, and the other competitors in the market who charge what, 0.25%, who might not provide the same amount of investment performance, but from a cost perspective. And maybe let's touch into that on two different elements. Number one, is there such a thing as an average or industry average fee for a particular investment vehicle, be it unit trusts or ETFs? And secondly, how does one discern between cost effectiveness when it comes to an investment product versus the returns that you're expecting to receive?
Yeah, look, I think cost definitely does become a factor when it comes to investment performance, purely on the basis that to be able to deliver an effective equity fund as opposed to an ETF, which is effectively generically a tracker, the costs of delivering that tracker are significantly lower, and therefore obviously a lower fee is passed on to the client. The upside benefit of having an actively managed fund obviously is that when markets go through very volatile stages, the active manager is able to adjust the asset allocation to make sure that you don't necessarily track a negatively moving index, whereas an ETF manager would be restricted from doing so in terms of his mandate. So, you know, to an extent you're paying for what you get, to a large extent. I think what's very important though when it comes to performance of investments is really the fee related to it is one component, but more importantly the risk related to it is the more important component that the client should be looking at. A client does need to understand that the more risk you take, the likelihood is that your returns would be higher over time, but that you'll experience significant volatility or fluctuations in your investments over a period of time. The less risk you take, the lower the likelihood is of high-level fluctuations in your investment returns. So you need to understand that client's appetite for risk and his ability in terms of his financial structure to accommodate risk, making sure that obviously he has a short-term, a medium-term and a long-term structure within his whole investment portfolio.
Exactly. Yeah. On that investment portfolio, we always hear that you need to review your investment portfolio as well as the criteria, and if you are still set on meeting your objectives, how often should one review their fees then?
Absolutely. I think as a start, the first objective that you should want to achieve is to put together a very comprehensive financial plan. And that financial plan will outline your structure, your product structure, your tax structure, as well as your fee structure across the various products that are required to fulfill your financial plan. That review should take place, a regular review of that plan should take place at least annually as an absolute minimum, so that you understand whether you're achieving your various objectives. And during that review, you need to at the same time review the fee structures applicable to the various components of your investment portfolio, because markets change, mortality rates change. The competition obviously is driving prices down in various areas. So what you very often find is that the newer generation products are significantly cheaper than the very older generation products. So it's quite important to review your portfolio and look at those old investments that you haven't looked at for a long time, because you may find that you can actually get a much better fee structure put in place and achieve the same objectives as you originally intended.
And obviously a lot of collaboration between yourself and the financial advisor needs to come into play.
Absolutely.
If ever there's conflict there, what kind of recourse do you have when it comes to issues arising from fees?
Look, effectively your financial advisor is governed by the Financial Advisory and Intermediary Services Act. The FSB, the Financial Services Board, is the regulator of that industry. And advisors are required in terms of their licensing to deliver fair services to clients. And if a client is unhappy with what's being achieved or delivered by his advisor in terms of the original commitment relative to the outcome, a client has the absolute responsibility almost to go to the Financial Services Board and report that advisor. The objective being that we want to make sure that advisors throughout the industry do deliver on their actual commitments to clients.
Exactly. We don't want one rotten apple spoiling the bunch.
Absolutely. Another thing I'd love to add, of course, is that when you do go out and into the market and look for an advisor, have a look at the Financial Planning Institute website. They have listed all of their certified financial planners, and the benefit of that to a client is that the Financial Planning Institute has certain requirements that they place on all of their CFPs in terms of continuous professional development, remaining upskilled and relevant in the industry. And I think that goes a long way to making sure that clients do ultimately get very good quality advice.
Well, time now for us to recap on the takeaways from this discussion. Pete, we've said a mouthful, but for someone watching this at home this evening, what are the key 5 considerations they need to take into account?
I think key would be to make sure that you have an effective financial plan put in place in advance and that you understand the products and the related fee structures. Secondly, make sure that you do have a service level agreement in place with your advisor. This is a person that you need to build a very long-term valued relationship with. It's not somebody fulfilling a simple need. It's somebody that's going to make sure that you achieve your ultimate objectives for you and your family from a financial point of view. Thirdly, I would say make sure that you review your portfolio on a regular basis, as I said earlier, at least annually. I would also ensure that you keep up to date yourself with what is going on in the market, what is available in the market. There's no, your advisor obviously tries to keep up to date with various products and services, but you may come across some that you can quiz him about. So really important to remain involved yourself. And then finally, make sure that you do appoint a CFP qualified financial advisor to look after your affairs. I think it'll add a lot of value to your life.
Exactly. Thank you so much for your insights this evening. Much appreciated. Well, that's where we leave it for Personal Finance this evening. Peter certainly educated us. He is a certified financial planner, Peter Hewett. Now, do remember that we want to hear from you, so send us your insights and your suggestions or even comments to @CNBC Africa using the hashtag Finance410 or to myself @Gukumfupi on Twitter. Until next time, it's goodbye for now.